It means calm waters, that this market has been extraordinarily resilient in digesting headlines that we might have thought could cause more volatility, mostly in a month like August, where trading volumes are lighter. But this market continues to just power on, and we think it's driven by two key things. The first one being that liquidity remains very abundant. And the second thing is that earnings estimates are going up. Risk assets love it when earnings estimates and growth estimates are going up. So when you distill it down to those two things, you can see why we've been resilient. But of course, it makes you raise an eyebrow if we're thinking we could be becoming complacent.
Any rotations out of what's really been working, what's always seemingly been working, the big cap tech names? Have we seen any are people trying to broaden out at all?
Yesterday was a big rotation day under the surface. It looked calm on the surface of the S&P 500, but kind of like a duck spinning its legs under the water. We were seeing huge rotations where you saw the NASDAQ, AI trades all trade off rather sharply, and things like Russell 2000 doing a lot better yesterday.
But that could be a one-off, right? I mean, in this environment,
yes.
How does someone like you bet on a rotational shift?
Well, I think the one thing that we've been noting over the course of the last few days is that growth versus value has gone parabolic in the last month or so, meaning that growth has outperformed value almost in a straight line up. And what we see is after each of those parabolic moves, we had one in December of last year, we had one in July of last year, that you typically see a correction, meaning just a reversion back to the mean. So we wouldn't be surprised if you saw growth take a breather because it's been so strong, but that doesn't mean it's not still in an uptrend, which it still very much is.
How much does this market need the Fed to cut? Do they need a gradual cut? Do they need something more aggressive? We've had talk of a 50 basis point cut kind of creep into the conversation, not just 25 in September.
It's the why they're cutting, which is so important. If they're cutting because growth is much weaker than expected, we're marking down forecasts, then them doing a 50 basis point cut because the economy needs the stabilization, that's not good for markets. If they're cutting because they want to get to this idea of neutral, inflation has moderated, growth is slowish, but still healthy, then that's a place where markets tend to celebrate. But it's two very different scenarios.
I mean, I know you weren't listening to the show earlier, Kim, because you're out signing autographs, but the bottom line is off the Besson interview with Jonathan Farrow yesterday, this idea of cutting rates massively has a massive ambiguity to it. I mean, you know, on a microeconomic basis, it could cut either way.
Well, there was a line down Lexington for the autographs, if you were wondering. The second one is that it really depends on where economic surprises go for the response to rate cuts. Last year, when the Fed cut rates by 100 basis points and the 10-year went up by 100 basis points, it's because economic surprises were going straight up. Data coming in better than expected, as well as GDP forecasts being revised higher. They were being revised higher by almost 70 basis points during those months.
Do you have a clue what earnings are ending 9/30? JP Morgan will be 10/16, 10/17-ish. Technology will be November 1. Do you have any clue? How do you do it?
Well, we're in the 270-ish range for 2025. We do know that earnings have continued to come in better than expected. Look at the second quarter, 11.8% growth versus the 4.9% that was expected going into the quarter. But then as you turn your eyes to 2026, there's about a $300 estimate for S&P 500 earnings. That includes not only an acceleration in the top line, but over 100 basis points of margin expansion. So there's some optimism that's already being contemplated.
Kim.